The America Incorporated Blueprint. How sovereign venture capital and strategic tariffs offer the most viable path toward fiscal sustainability. For decades, mainstream macroeconomics has offered a rigid, painful gospel for solving a sovereign debt crisis: raise taxes or slash spending. In a deeply polarized political landscape, both options represent a form of electoral suicide. Direct tax hikes trigger immediate voter outrage, while cutting entitlement or defense programs sparks paralyzing social unrest. Neither is politically executable at the scale required. The honest starting point for any serious policy discussion is this: there is no perfect solution to a $39 trillion debt that is growing by roughly $7 billion every single day. 6. Any framework that claims otherwise is selling something. The relevant question is not which option eliminates the problem overnight, but which option moves the needle most effectively, with the least political and human cost, while remaining adjustable as conditions evolve. By that standard, the emerging America Incorporated model, combining sovereign venture capital with strategic tariff protection, is not merely an interesting theory. It is the most pragmatic and politically durable framework currently available. Properly designed and governed, it generates 5 compounding dividends that no conventional fiscal or industrial policy has ever delivered simultaneously. The 5 dividends of the America Incorporated model. The fiscal dividend, a triple-engine revenue mechanism that expands the tax base, captures sovereign equity returns, and harvests capital gains windfalls, without raising a single statutory tax rate. The flexibility dividend, a growing pool of sovereign capital deployable to urgent social needs wherever and whenever they arise, without new debt, new taxes, or permanent entitlement obligations. The competitive dividend, state-backed and citizen-owned firms gain lower cost of capital, longer investment horizons, and a loyal domestic demand base that makes them structurally superior to purely private global competitors. The unity dividend, broad citizen ownership, aligns the financial fate of every American with the success of the national industrial portfolio, dissolving the zero-sum economic divisions that have fractured the country for 4 decades. The democratic dividend, through sovereign bonds and citizens' portfolio accounts, every American becomes an owner, not just a taxpayer, of the national industrial revival, transforming industrial policy from a government program into a genuine national stakeholder movement. Crucially, this is not an argument for trusting the government with unchecked power over industrial capital. The model proposed here is accompanied by 3 concrete institutional guardrails: an independent sovereign investment board, disciplined tariff sequencing with enforceable sunset conditions, and a transparently governed sovereign fund modeled on Norway's permanent fund, that depoliticize decisions and protect the public interest. 2. 4. The urgency of that choice is not abstract. Annual interest payments on the national debt now exceed $1 trillion, surpassing both the entire defense budget and Medicaid individually, ranking 3rd among all federal expenditure categories behind only Social Security and Medicare. 4. Debt held by the public has crossed 100% of GDP for the first time since World War II, and the Congressional Budget Office projects it rising to 120% of GDP by 2036. 7. The United States is not approaching a fiscal crisis. It is already inside one, adding roughly $7 billion to the debt every single day. 6. In that context, waiting for a perfect solution is not prudence, it is a choice to let the problem compound. It is also worth asking how the debt reached this point. A significant portion traces directly to decades of unconditional corporate subsidies, a model that was not merely inefficient but fundamentally unfair to taxpayers. Under the old paradigm, the federal government borrowed money, handed it to corporations with no conditions, and those corporations used the liquidity to fund stock buybacks and executive compensation packages while the public absorbed 100% of the risk. 1. The $1 trillion in annual interest payments is partly the compounded bill for that arrangement. A transfer of wealth from ordinary households to private shareholders, financed by public debt. Every American family now carries an implied share of approximately $288,000 in national debt. 6. Much of it the legacy of a system that privatized gains and socialized losses. The America Incorporated model is not merely a fiscal fix. It is a structural correction of that injustice. 1. The course shift, from subsidies to investment. The historical failure of government industrial policy, Solyndra, Fisker, and dozens of others, is frequently cited as evidence that the state cannot pick winners. But this critique misidentifies the cause of failure. Those programs did not fail because the government was involved, they failed because the government behaved as a benefactor rather than an investor. More critically, when they did succeed, taxpayers saw none of the financial reward, the upside flowed entirely to private markets while the public bore the downside alone. The distinction is critical. A benefactor writes a check and walks away. An investor attaches conditions, retains upside, monitors performance, and reserves the right to intervene. The America Incorporated model applies the latter discipline through three structural mechanisms. Sovereign equity stakes and warrants, the Treasury participates in the upside, not just the risk. 1, 2. Performance covenants and milestone gates, funding is conditional on hitting operational targets, not political ones. 1. Board-level governance rights, the state retains authority to block value-destroying decisions, technology transfers, or foreign acquisitions. 5. This is not speculative. TARP, the 2008 bank bailout, applied exactly this structure and returned a net profit of roughly $15 to $20 billion to the Treasury. 2. The CHIPS Act formalized the equity kicker approach for technology sectors, requiring upside-sharing mechanisms for awards exceeding $150 million. 1. The Department of Defense acquired preferred stock in MP Materials paired with a 10-year offtake agreement. 1. These are not theoretical frameworks, they are operational precedents. The transition from benefactor to investor does not guarantee success. Even sophisticated private venture capital firms fail the majority of their bets. What it does is fundamentally change the risk-reward structure so that when bets succeed, the public treasury captures the gains rather than leaving them entirely to private shareholders. That is not just better economics. It is a fairer bargain for the taxpayers who have been funding corporate growth without sharing in its rewards for decades. And in its most ambitious evolution, that bargain becomes direct. Through sovereign bonds and citizens' portfolio accounts, the equity upside the government captures on behalf of the public can be distributed back to citizens as personal ownership stakes, transforming abstract fiscal benefit into a tangible annual return in every participating American's account. 9, 10. 2. The tariff moat, protection with a purpose. An equity stake is only valuable if the underlying business becomes profitable. In an era of overwhelming foreign industrial overcapacity, built through decades of state subsidies abroad, nascent domestic supply chains cannot survive a pure price war. The solution is temporary protective tariffs, applied not as permanent walls but as incubation shields. 3. Critics raise two standard objections. First, that tariffs impose consumer costs. Second, that trading partners retaliate. Both objections are valid. Neither is disqualifying. On consumer costs. Tariff-driven price increases are real and should not be minimized. They are also regressive in isolation, falling harder on lower-income households as a share of spending. However, they cannot be evaluated in isolation. The relevant comparison is not tariff inflation versus zero inflation, it is tariff inflation versus the available alternatives. A direct tax increase concentrates the burden immediately and visibly. Entitlement cuts fall hardest on the most vulnerable. Neither generates jobs. The tariff model, by contrast, pairs its consumer cost with a compensating employment effect. Reshoring manufacturing creates jobs, wages, and tax revenues in the communities that have borne the heaviest costs of deindustrialization. 3. For working-class households in former industrial regions, higher prices on imports combined with a factory job is a substantially better deal than lower prices combined with unemployment. It is fair to note that highly automated modern manufacturing, semiconductors, quantum computing, generates fewer jobs per dollar of investment than traditional industry. This is a genuine limitation of the employment offset argument for capital-intensive sectors. It argues for complementary workforce development policy alongside the tariff framework, not against the framework itself. Critically, the political calculus of tariff-driven consumer costs shifts fundamentally once democratic ownership becomes a reality. A citizen who holds a citizen's portfolio account and receives annual dividends from the domestic semiconductor or rare earth portfolio is no longer a passive victim of import inflation. They are a co-owner of the firm being protected. Their calculation changes from, "I am paying more for goods," to, "I am paying a modest premium to protect an asset I own that is growing in value." This ownership effect is not speculative. Alaskan residents consistently support the industrial policies that sustain the permanent fund precisely because they receive a direct, visible return from its performance. 10. On retaliation. Trading partners do retaliate, and they are strategically intelligent about it, targeting export-dependent sectors in politically sensitive states to generate domestic pressure for policy reversal. The 2018-19 trade war cost American soybean farmers billions and is a legitimate cautionary example. The critical question, however, is whether retaliation invalidates the model or simply represents a transitional cost that must be managed. The America Incorporated framework is explicitly designed as a time-limited incubation strategy, a 5 to 10-year protected runway before domestic industries are competitive enough to operate without shelter. 3. The model does not claim permanent tariff walls are desirable. It claims temporary protection creates the conditions for eventual competitive independence. The genuine risk is not that retaliation destroys the model economically but that it creates sufficient political pressure to force premature withdrawal before the incubation period completes. This demands deliberate mitigation, diplomatic negotiation to limit retaliation scope, support mechanisms for affected export sectors during the transition, and robust public communication about the long-term strategic rationale. The model's strongest political defense against premature withdrawal, however, is democratic ownership itself. Once millions of Americans hold citizens' portfolio accounts tied to the performance of state-backed industries, dismantling the tariff protection before those industries are globally competitive becomes an act of self-harm that the electorate will resist. Public ownership transforms the incubation period from a technocratic policy choice into a personal financial interest, and personal financial interests are far harder to vote away than abstract trade theories. 3. The triple-engine fiscal mechanism. Once a strategic industry matures behind protective tariffs, the fiscal loop closes through 3 compounding channels. Sovereign equity returns. As a shareholder, the Treasury collects dividends during peak cycles and realizes capital gains when it gradually unwinds positions into private markets, as it successfully did with TARP bank warrants. 2. Expanded corporate tax base. By retaining consumer spending domestically that would otherwise leak to foreign producers, the tariff mode expands the absolute volume of domestic corporate profits subject to taxation, without requiring any change to the statutory tax rate. 4. Capital gains multiplier. Modern equity markets amplify corporate profit growth 20 to 30-fold through P/E multiples. As state-backed firms appreciate, investors realize gains that generate a secondary wave of dynamic tax revenues, through capital gains and dividend taxes, that grow automatically with corporate valuations. This is the political masterstroke of the model. It bypasses the dead end of raising statutory tax rates entirely. Instead of demanding that wealthy investors and corporations pay more by legislative force, the framework creates conditions under which they pay more as a natural consequence of their own growing profits, willingly, and at scale. 2. It is important to be precise about the scale of this mechanism. These 3 engines will not erase a $39 trillion debt in any foreseeable timeframe. 6. That is not the appropriate benchmark. The relevant question is whether this framework generates more fiscal benefit per unit of political and economic cost than the available alternatives. The answer, on honest analysis, is yes, and it does so while simultaneously advancing national security, industrial competitiveness, and employment objectives that have independent strategic value beyond the debt question alone. Furthermore, as democratic ownership broadens through citizens' portfolio accounts, the fiscal engines themselves strengthen. Citizen shareholders drive domestic consumer preference toward portfolio companies, expanding the corporate tax base that Engine 2 depends on and amplifying the equity valuations that Engine 3 harvests through capital gains. The ownership model and the fiscal mechanism are not parallel tracks, they are compounding loops. 10, 12, 14. The fourth dividend, sovereign fiscal flexibility. The triple engine mechanism captures the model's fiscal logic, but there is a fourth benefit that may prove equally consequential: genuine policy flexibility. Every traditional fiscal tool is structurally rigid. Tax revenues are politically earmarked or locked in appropriations battles. Deficit spending accumulates interest that compounds the very problem it was meant to solve. Entitlement programs are legally immovable. Austerity cuts are one-directional, they reduce capacity but cannot redeploy it. The America Incorporated model breaks this rigidity entirely. Tariff receipts flow to the Treasury as general, unencumbered revenue, for equity dividends and capital gains from sovereign stakes are likewise discretionary. The result is a growing pool of deployable capital that sits outside the normal appropriations process, available to address urgent social needs wherever and whenever they arise, without issuing new debt, without triggering a congressional tax fight, and without creating permanent entitlement obligations that future administrations cannot unwind. This is not a hypothetical design feature. Norway's government pension fund Global, built on sovereign oil revenues rather than grants, gives Oslo precisely this capacity: the ability to fund social programs countercyclically, absorb economic shocks, and respond to national emergencies without borrowing. The America Incorporated model is constructing a structurally equivalent buffer for the United States, built not on commodities but on industrial equity and trade architecture. This flexibility also answers the most persistent political objection from the left, that the model primarily benefits corporations and Wall Street. The sovereign revenue it generates is precisely what funds the social safety net without adding to the debt that eventually crowds out that same safety net. The framework does not force a choice between industrial strength and social investment. It makes one the funding mechanism for the other. And when sovereign revenues are distributed through formula-driven citizens' portfolio accounts rather than discretionary government spending, that flexibility is governed by the most powerful accountability mechanism available: 50 million citizen shareholders watching their annual returns and demanding the policies that protect them. That is a political and economic alignment that no previous policy architecture has achieved. Four. From blueprint to reality. This framework is not theoretical. The U.S. government has already deployed it across several critical sectors. Intel Corporation, an $8.9 billion federal investment converted into an approximately 10% equity stake, providing the Treasury direct participation in any operational recovery of a strategically critical semiconductor manufacturer. 1. Quantum computing. The Department of Commerce deployed $2 billion under the CHIPS Act across 9 quantum computing firms, acquiring minority equity stakes rather than issuing unconditional grants. 1. MP Materials, a $400 million preferred stock acquisition by the DoD, paired with a 10-year military offtake agreement, insulating the domestic rare earth supply chain from foreign predatory pricing. 1. U.S. Steel, CFUS review leverage to impose a golden share governance structure, giving Washington veto authority over offshoring or dismantlement of critical legacy industrial infrastructure. 5. The 2008 precedent, when structure determined the outcome. The most definitive proof that investment structure, not government involvement itself, determines success or failure comes from the 2008 financial crisis. Faced with a systemic collapse, Washington deployed capital across multiple sectors simultaneously. The results were not uniform, and the divergence is instructive. Where the government structured its intervention as equity with mandatory return mechanisms, taxpayers profited. AIG received approximately $182 billion in emergency support in exchange for a near 80% equity stake via warrants. 8. As AIG's core insurance business recovered once the crisis stabilized, the Treasury methodically sold down its position. The final result was a positive return of $22.7 billion for taxpayers, on what had been the most reviled bailout of the era. 8. Fannie Mae and Freddie Mac tell an even more striking story. The Treasury disbursed $187 billion to keep the two mortgage giants solvent, taking senior preferred stock with a mandatory dividend sweep in return. 8. Over the following years, as the housing market recovered and profits flowed, the dividend sweep mechanism automatically directed those profits back to the Treasury. The final tally, $250 billion returned on a $187 billion outlay, a $63 billion profit for the public purse, generated not by raising a single tax rate but by the compounding logic of structured equity. 8. The contrast with the automotive intervention is equally instructive. GM, Chrysler, and Mack together received $79.7 billion, much of it as stock. 8. However, the political urgency of saving manufacturing jobs led to weaker covenant structures and less rigorous performance conditions than the financial sector interventions carried. The result was a net loss of approximately $27 billion to taxpayers. The lesson is not that the automotive intervention was wrong. Preserving hundreds of thousands of jobs and an entire industrial supply chain had value that transcends a balance sheet. The lesson is that disciplined covenant design is the variable that separates profit from loss. The instrument matters as much as the intent. Taken together, the 2008 interventions constitute the largest real-world stress test of the sovereign investment model in American history. The verdict is unambiguous: equity structure with mandatory return mechanisms works. Unconditional capital does not. The America Incorporated blueprint is not a new idea, it is the disciplined application of a lesson the United States already paid $700 billion to learn. Returning to the present portfolio, the same logic applies. Intel has faced significant operational headwinds since the investment, a reminder that even well-structured government investment carries real risk. But because the government holds equity warrants and performance covenants with liquidation preferences, rather than having issued an unconditional grant, it retains full legal sovereignty to intervene, impose restructuring, replace management, or cut losses before further public capital is destroyed. A conventional subsidy would have left taxpayers with nothing but the bill. The equity structure preserves options and accountability. Intel's difficulties are not a weakness of the model, they are a live demonstration of why the model exists. Looking further ahead, each of these existing sovereign positions, the Intel stake, the MP Materials preferred stock, the quantum computing portfolio, represents a natural candidate for a future citizen's portfolio account tranche. The government's current holdings are not the end state of the model. They are the seed capital for the national ownership movement that follows. '5. Building the guardrails, institutional design for a sovereign investment state. The America Incorporated model's logic is sound. But logic alone does not build institutions. 3 structural risks: political capture of investment decisions, inflationary overreach in tariff application, and the abuse of executive fiscal discretion, are real enough that dismissing them would undermine the very credibility the model needs to succeed. The answer is not to abandon the framework. It is to design the guardrails that make it durable. Guardrail 1: Depoliticizing investment decisions. The most persistent objection to state-directed investment is not that the equity structure is flawed, it is that political pressure will prevent the government from ever letting a state-backed firm fail cleanly, and equally, from ever harvesting exorbitant profits without triggering public backlash. Both ends of the return distribution are politically constrained in ways private capital is not. This is a genuine vulnerability, and it demands a structural solution rather than a promise of good intentions. The solution is an independent sovereign investment board, modeled on the Federal Reserve's institutional insulation from day-to-day political interference, with statutory authority to make monitor, and exit investment decisions according to predefined financial criteria rather than electoral calendars. 2. Board members should serve staggered, non-renewable terms. Investment mandates should be written in legislation, not executive orders. Exit triggers, the conditions under which the government sells a position, restructures a failing investment, or writes down a loss, should be defined in advance and made public, removing the discretion that political pressure exploits. The TARP precedent is again instructive. The Special Inspector General for TARP, SIGTARP, provided exactly this kind of independent oversight, and it worked. 2. Accepting visible losses on failed investments is not a weakness of the model. It is proof that the model is functioning as designed, distinguishing it from the unconditional subsidy system where losses were simply absorbed silently into the national debt. A government that can publicly exit a bad investment is more credible, not less. Guardrail 2, Disciplined tariff sequencing. The stagflationary risk is real but avoidable, if tariff application is staged and targeted rather than broad and simultaneous. The concern is legitimate. If protective tariffs are applied across semiconductors, rare earths, quantum computing, steel, and advanced batteries at the same time, compounding input cost increases cascade through interconnected supply chains and could suppress the very corporate profitability and capital gains the triple engine mechanism depends upon. The discipline required is sequencing by strategic priority and supply chain independence. Tariffs should be applied sector by sector, in order of national security criticality, with each sector's protection reviewed against a predetermined competitiveness benchmark before the next is activated. 3. A sector graduates from protection when it demonstrates cost parity with foreign competitors within a defined margin, at which point tariffs are phased down on a published schedule. This graduated architecture prevents the compounding inflation risk while preserving the incubation logic, and it creates a credible sunset mechanism that answers the legitimate concern that temporary protection becomes permanent. The Hamilton and List tradition that the article draws on explicitly contemplated this discipline. Infant industry protection was always theorized as time-limited and tied to demonstrated maturation, not indefinite. 3. The policy failure in historical cases, U.S. Steel being the canonical example, was not the theory but the absence of enforceable sunset conditions. Writing those conditions into the enabling legislation is the structural fix. Guardrail 3, Governing the Sovereign Fund. The sovereign fiscal flexibility described in Section 3 is the model's most powerful feature and its most politically exposed one. A pool of capital that sits outside the normal appropriations process, directed by the executive branch, will be characterized by critics across the political spectrum as a slush fund, a vehicle for crony capitalism on the right, a corporate subsidy machine on the left, and a constitutional overreach by both. The Norway comparison, while analytically apt, can inadvertently strengthen this critique if the governance difference is not made explicit. Norway's government pension fund global is not simply a pool of discretionary executive capital. It is governed by an independent board operating under a statutory investment mandate, subject to parliamentary approval of its strategic framework, with full public transparency on all holdings and returns. The Storting, Norway's parliament, sets the fund's risk parameters and ethical guidelines. The executive cannot unilaterally redirect the fund toward political priorities. The American equivalent must be designed with equivalent rigor. Congressional legislation should establish the fund's mandate, define permissible asset classes, set spending rules, including a structural firewall preventing drawdown except under defined emergency conditions approved by a supermajority, and require annual independent audits published in full. For, critically, the fund's social deployment mechanism should be formula-driven rather than discretionary. A defined percentage of annual returns allocated to a social stabilization reserve, dispersed by an independent board against objective need metrics rather than political judgment. This preserves the flexibility that makes the model valuable while closing the governance gap that makes it vulnerable. Designed this way, the sovereign fund becomes not a threat to constitutional spending checks but a reinforcement of them, a rules-based alternative to the debt-financed emergency spending that currently bypasses those same checks every time a crisis hits. The fourth guardrail, democratic ownership. There is, in fact, a fourth guardrail that no independent board or legislative mandate can fully replicate: democratic ownership itself. When millions of citizens hold equity stakes in the sovereign portfolio and receive annual returns tied to its performance, they become the most powerful oversight body imaginable, one that cannot be captured, lobbied, or politically pressured into silence. A government that mismanages the portfolio answers not just to Congress or an inspector general but to every account holder who opens their annual statement. Citizen ownership is accountability at scale. 9-10. 6. The case for directional progress over perfect solutions. Every significant economic transformation in modern history, the New Deal, post-war Reconstruction, the East Asian developmental miracle, succeeded not because it was perfectly designed at the outset, but because it was directionally correct and iteratively refined. 3. The New Deal was adjusted repeatedly. TARP was modified mid-execution. 2. Japan's industrial policy evolved across decades. None arrived as a finished blueprint. The America Incorporated framework should be evaluated on the same terms. Its value is not that it solves the debt crisis completely, it does not. Its value is that it moves fiscal, industrial, and national security objectives simultaneously in the right direction, with mechanisms that can be strengthened, adjusted, or redirected as evidence accumulates. Demanding a complete, risk-free solution before acting is itself a policy choice, and not a neutral one. When the federal government is already paying over $1 trillion annually just in interest, more than it spends on defense, more than it spends on Medicaid, for every year of inaction is not a pause. It is an active decision to let the cost of past inaction consume an ever larger share of future budgets, crowding out investment in exactly the infrastructure, research, and workforce development that could drive growth. 7. A perfect framework does not exist, and no one has one in development, because complex national challenges do not admit perfect solutions. They admit better and worse ones. The only real choice is between an imperfect framework that acts and an absence of framework that compounds the damage daily. Waiting is not a neutral position. It is a decision, and its costs are measured in billions every single day. And as democratic ownership broadens, the feedback mechanism for iterative improvement strengthens with it. Citizen shareholders generate continuous political pressure not merely to defend the model but to improve it, demanding better covenant enforcement, tighter tariff sequencing, more transparent fund governance, in ways that neither bureaucratic review nor electoral cycles alone can sustain. 7. Democratizing ownership, bonds, public equity, and the national stakeholder model. The model as described so far concentrates the financial upside of sovereign investment in two places: the U.S. Treasury and institutional capital markets. Both benefit when a state-backed firm appreciates. Ordinary citizens benefit only indirectly, through the fiscal revenues the Treasury eventually deploys. This is a significant untapped opportunity. The logical next evolution of America Incorporated is to open the ownership structure to broader public participation, transforming a government investment program into a genuine national ownership movement. Mechanism 1: Sovereign portfolio bonds. Standard Treasury bonds are backed by the government's taxing authority alone, an abstract promise to collect future revenues. America Incorporated bonds would be structurally different, backed by the actual revenue-generating assets of the sovereign portfolio, tariff receipts, equity dividends, and capital gains from government stakes in Intel, MP Materials, quantum computing firms, and future additions. 1-9. This asset-backed structure, analogous to revenue bonds in municipal finance, gives investors a tangible claim on real industrial cash flows rather than a general government promise. The practical result is a potentially lower borrowing cost than standard treasuries, because the collateral is more concrete, and a new class of buyer, investors who want exposure to American industrial revival without bearing direct equity volatility. This mechanism also creates a powerful political feedback loop. Citizens and institutions that hold America Incorporated bonds have a direct financial interest in the portfolio's success. They become active constituents for the policies, tariff discipline, covenant enforcement, independent governance, that protect their investment. Public ownership builds public accountability in a way that government programs alone never can. The historical precedent is well established. U.S. war bonds during World War II raised over $185 billion from ordinary Americans, built enormous political buy-in for the national strategic effort, and returned principal with interest. 9. The mechanism is not novel, applying it to a sovereign industrial portfolio rather than wartime financing is the innovation. Mechanism 2, Public Equity Participation, the Citizens' Dividend. Beyond bonds, a portion of the sovereign equity stakes could be made directly accessible to American citizens through a publicly available investment vehicle, structured similarly to a national index fund, with shares purchasable at low minimums and held in a dedicated citizens' portfolio account. Rather than the Treasury holding 100% of its Intel stake or quantum computing positions internally, a defined tranche would be ring-fenced for public ownership, with returns distributed as an annual dividend to participating account holders. The Alaska Permanent Fund provides the most direct American precedent. Since 1982, Alaska has distributed an annual permanent fund dividend to every eligible resident from the returns on its sovereign oil wealth portfolio. 10. The result is not merely financial, it has created one of the most durable political coalitions in any American state in defense of a public asset. Alaskans across party lines consistently resist attempts to raid or privatize the fund because they receive a direct, visible, annual benefit from its performance. The America Incorporated equivalent would replicate this dynamic at national scale, giving every participating American citizen a personal financial stake in the success of domestic semiconductor manufacturing, rare earth independence, and quantum computing leadership. Singapore's Temasek Holdings offers a complementary model at the sovereign level, a state-owned investment company that holds equity stakes in strategic national enterprises, issues public bonds, and operates under full commercial discipline with published annual returns. Temasek has compounded at approximately 14% annually since its 1974 founding, outperforming most private equity benchmarks, precisely because its governance insulates investment decisions from political interference while maintaining public accountability through transparent reporting. 11. The risk architecture, how taxpayer backing works. The taxpayer backstop requires careful structural definition. Public participation instruments should be tiered by risk. Sovereign portfolio bonds would carry a full government principal guarantee, similar to savings bonds, with interest tied to portfolio performance above a floor rate. Public equity participation accounts would carry no principal guarantee but would benefit from the portfolio's diversification across multiple sectors and the government's governance rights, which reduce the tail risk of catastrophic loss. Critically, the government's role as backstop does not mean absorbing unlimited private risk. The sovereign guarantee covers the structured bond layer, the equity participation layer is explicitly at-risk capital, disclosed as such to participants. This tiered architecture, guaranteed bonds for risk-averse citizens, equity participation for those willing to accept volatility in exchange for upside, makes the national ownership model accessible across the full spectrum of American household financial situations. The political transformation this enables is profound. When ordinary Americans can open a citizen's portfolio account, purchase America Incorporated bonds at their local bank, and receive an annual statement showing their share of national industrial returns, the debate around sovereign investment shifts entirely. It is no longer a story about government bureaucrats picking corporate winners with taxpayer money. It becomes a story about every American owning a piece of the national industrial revival, and receiving a direct financial return when that revival succeeds. 9, 10, 11. The competitive dividend of democratic ownership. There is a further, underappreciated dimension to broad public ownership that transcends the fiscal and political arguments. It makes the underlying companies genuinely more competitive in global markets, structurally and permanently, not merely for the duration of tariff protection. The first advantage is cost of capital. When a company carries sovereign backing and is held in part by citizen investors through a national ownership vehicle, bond markets and equity markets price in that backing as a credit enhancement. The firm's perceived default risk falls, and with it the interest rate at which it can raise private capital. This structural borrowing cost advantage compounds over decades. TSMC, Samsung, and Airbus all benefit from exactly this implicit sovereign premium. It is one of the primary reasons their Western purely private competitors have struggled to match their long-term capital deployment capacity. 11, 12, 14. The second advantage is investment horizon. Private firms are constrained by quarterly earnings cycles and institutional shareholders seeking near-term returns. State-backed firms with broad citizen ownership can credibly commit to 10-, 20-, and 30-year investment horizons, the kind of patient capital that builds genuinely dominant global industries rather than merely profitable ones. TSMC spent decades building its foundry dominance under state backing before becoming commercially self-sustaining. 12, 13. Democratic ownership gives American firms the same license for patient capital that Asian national champions have always enjoyed, without requiring the authoritarian governance structures that make those models politically unacceptable in a democratic society. The third advantage is the national champion consumer effect. When millions of Americans hold Citizens' portfolio accounts and receive annual dividends tied to the performance of domestic semiconductor, rare earth, and quantum computing firms, their relationship with those industries changes fundamentally. They have a personal financial reason to support domestic manufacturers, choose American-made products, and resist foreign undercutting politically. This creates a self-reinforcing domestic demand base that private companies cannot manufacture through marketing alone. It is loyalty backed by ownership, precisely the structural advantage that state-backed enterprises in China, South Korea, and Taiwan have long benefited from in their home markets. 10, 11, 14. Most critically, democratic ownership solves the clean exit problem that has plagued every previous iteration of American industrial policy. The tariff protection is explicitly temporary, but sovereign equity and citizen ownership are not. When the incubation period ends and domestic industries face full global competition, they enter that competition with lower cost of capital, a loyal ownership base, patient investment horizons, and a talent advantage that national mission creates. The tariff crutch is no longer needed because the ownership structure itself has become the competitive moat. This is the graduation from protected infant to global champion that the Hamilton and List tradition always theorized but industrial policy rarely achieved, because previous models had no mechanism to sustain competitive advantage after protection ended. 3, 10, 11, 12, 14. The political durability this creates is equally significant. If 50 million Americans hold Citizens' portfolio accounts and receive annual dividends from the sovereign industrial portfolio, dismantling America Incorporated becomes politically equivalent to abolishing Social Security. Democratic ownership does not merely make companies more competitive, it makes the entire policy framework self-defending across administrations, party cycles, and decades. That is the institutional permanence that no previous American industrial policy has ever achieved. The unity dividend, ownership as national cohesion. Beyond competitive advantage, democratic ownership carries a dimension that no fiscal mechanism alone can generate. It has the potential to fundamentally reknit the social fabric of a nation that has been pulled apart by 4 decades of unequally distributed economic growth. This is not a secondary benefit of the model. In the long run, it may be its most consequential one. The deepest structural divisions in contemporary American economic politics, globalization's winners versus its losers, capital versus labor, coastal versus interior, are fundamentally disputes about who benefits from the economy and who does not. Every industrial policy to date has sharpened those divisions. Tariffs benefit some industries and harm others, tax cuts flow to capital holders, subsidies are captured by firms whose shareholders are not the workers whose communities were hollowed out by deindustrialization. The result is a political economy in which every economic policy creates winners and losers who then fight each other permanently. 17. Democratic ownership breaks this zero-sum dynamic at its root. When every participating citizen holds a stake in the same sovereign industrial portfolio, the semiconductor firms, the rare earth producers, the quantum computing companies, their financial fate becomes structurally aligned. A factory worker in Ohio and a technology investor in San Francisco both benefit when the domestic semiconductor portfolio outperforms a foreign competitor. A retiree in Florida and a first-generation immigrant in Texas both receive a larger citizens' portfolio account dividend when MP Materials dominates rare earth production globally. Shared ownership creates shared interest where divided interest previously generated permanent political conflict. 1718. The historical evidence for this dynamic is compelling. When 85 million Americans, out of a population of 131 million, purchased war bonds during World War II, the program achieved something no amount of political rhetoric alone could have. It aligned the financial self-interest of ordinary citizens with the national strategic mission. 15. Contemporary surveys conducted after VJ Day recorded that participants cited the spiritual value of participation in a common national effort as a primary motivation alongside the financial return. 15. The bond program did not merely raise $185.7 billion, it transformed passive observers into active stakeholders in the national outcome. Democratic ownership in the America Incorporated model replicates this psychological and financial alignment, but on a permanent and compounding basis rather than a wartime emergency. South Korea provides the most instructive long-term case study. As Samsung, Hyundai, and LG grew from state-backed industrial projects into globally dominant enterprises, they did not merely generate economic growth, they generated national identity. Surveys consistently find that South Koreans across class, region, and political affiliation celebrate Samsung's global victories and rally behind its competitive battles as expressions of collective national achievement. 16. As one analysis observed, the world has gradually come to associate South Korea with Samsung and Hyundai rather than with the Korean War, a transformation of national brand that no government communication strategy could have engineered, but that material co-ownership and shared prosperity made inevitable. 16. The America Incorporated model is the first American industrial policy architecture designed to deliberately engineer this same dynamic, making the success of domestic national champions a personal financial event in the lives of ordinary citizens, not merely a macroeconomic abstraction. The World Bank's research on social cohesion identifies shared economic purpose, cross-group trust, and material interdependence as the three structural foundations of durable national unity. 17. Democratic ownership directly addresses all three. It creates shared economic purpose by aligning citizen financial interests with national industrial outcomes. It builds cross-group trust by establishing a common stake that transcends partisan, geographic, and class identity. And it creates material interdependence, the recognition that your prosperity and your neighbor's prosperity are linked through the same portfolio, that is the empirical foundation of cooperative civic behavior. Alaska's Permanent Fund offers perhaps the most striking American evidence of this dynamic in practice. The fund has generated one of the most durable cross-partisan political coalitions in any American state, with Republicans and Democrats, urban and rural Alaskans, indigenous and non-indigenous communities all united in their defense of the fund and resistance to attempts to raid or redirect it. 18. The reason is straightforward: every eligible Alaskan receives the same annual dividend check, creating a shared financial stake that cuts cleanly across every other dimension of political identity. At national scale, with a far larger and more diversified portfolio, the America Incorporated Citizens Portfolio account would replicate this dynamic with far greater force. The competitive implication of national unity is ultimately what connects this argument to the global stage. America's principal competitors, China, South Korea, Taiwan, Germany, deploy industrial capital with the weight of genuine national alignment behind it. That alignment is partly cultural and partly political, but it is also grounded in the material reality that ordinary citizens in those societies have experienced direct personal benefit from the success of their national industrial champions. Democratic ownership does not merely make individual companies more competitive. It makes the nation more competitive, by transforming the industrial project from a government program that divides into a shared enterprise that unites. That is the unity dividend, and it may be the most durable competitive advantage the America Incorporated model can deliver. Conclusion. The America Incorporated model carries real costs and real risks. Tariff-driven inflation imposes a distributed burden on consumers. Retaliation from trading partners threatens export sectors and tests political durability. Government-directed investment requires a discipline that does not come naturally to political institutions. None of these challenges are trivial, but none are insurmountable, and this article has proposed concrete institutional responses to each. But the alternatives, direct tax increases, entitlement reductions, or continued inaction, carry costs and risks that are larger, less manageable, and less likely to generate compensating benefits. By transforming the government from a passive benefactor into an active investor, 2, by using strategic tariffs as a time-limited incubation mechanism rather than a permanent crutch, 3, governing both through independent rules-based institutions, and ultimately opening the ownership structure to every American through sovereign bonds and public equity participation. This framework aligns national security, fiscal sustainability, economic revitalization, and democratic ownership in a way that no conventional austerity program, or conventional industrial policy, has ever attempted. It will not solve everything. It is not designed to. It is designed to move the United States in the right direction, on terms the political system can sustain, with mechanisms that improve over time. In the absence of perfect options, that is precisely what good policy looks like. The most transformative dimension of this framework is ultimately not fiscal, it is democratic. For the first time, an American industrial policy architecture offers every citizen not just the indirect benefit of a stronger economy, but a direct, personal financial stake in its success. When Americans can hold America Incorporated bonds, open a citizen's portfolio account, and receive an annual return from the national industrial revival their tax dollars helped build, the politics of industrial policy change permanently. They become owners, not just taxpayers. 9, 10, 11. And ownership changes more than politics. It changes competitive dynamics. Companies backed by sovereign capital and held by citizen investors carry lower borrowing costs, longer investment horizons, and a loyal national customer base that private competitors cannot replicate. When the tariff incubation ends and domestic champions enter global competition, they do so not as sheltered firms suddenly exposed to the market, but as deeply rooted national enterprises with structural advantages that compound over time. That shift, from subject to stakeholder, from protected infant to global champion, is what makes this model not merely the best available option, but the foundation of a genuinely new national compact. 3, 10, 11. Put simply, the America Incorporated model delivers 5 dividends that no previous fiscal or industrial policy framework has achieved simultaneously. A fiscal dividend that expands revenues without raising tax rates. A flexibility dividend that deploys sovereign capital to social needs without new debt. A competitive dividend that makes domestic champions structurally superior in global markets. A unity dividend that aligns every American's financial fate with the nation's industrial success. And a democratic dividend that transforms citizens from passive taxpayers into active owners of the national revival. Together, these 5 dividends constitute not merely a policy framework but a new national compact, one in which the success of the country is, for the first time, the direct and personal financial interest of every American who participates.